Hi everyone and welcome back to a brand new episode. My name is Marcus and I'll be your host. In today's episode we're going to take a look at HP and their ticker symbol is HPQ. If you're new to this channel, welcome. What we do is that we study and analyze stocks. We go through the fundamentals and the technical analysis of the stock, but we also talk about finance and investing. And if you've been here before, thank you so much for coming back. I truly hope you guys will enjoy this episode. And please give me a thumbs up, comment, subscribe, and let me know what you think, but also what stocks you want me to take a look at. Thank you so much. Now, let's get started. As I mentioned, we're going to take a look at HP, and if we go down to the screen, we can tell that they are traded on New York Stock Exchange and are in technology sector, and their market capitalization is at $31.9 billion, and their revenue is at $62 billion. Their PE ratio is at 8. I like this because I like to take a look at companies with a PE ratio of 20 or below. So having a PE ratio of 8, I like it. So that is a major goal. But this also tells you about the market expectation of the stock. So having a lower PE ratio, that means the market doesn't expect much from this stock. So you know. Now, the profit margin is at 6.5%. This is just way too low because I like to take a look at companies with a profit margin of 15% or higher. So having 6.5, that is just too low. So this is a no for me. Now, the price to sales ratio is at 0.5. Normally, I like to take a look at companies with a price to sales ratio of maximum 2. So having 0.5, I like it. So that is a go for me. Now, we don't have any data on the price to book value, but I can tell you that normally I like to take a look at companies with a price to book value of maximum 3. And if we summarize, the PE ratio is below 20, I like it. Profit margin below 15, that's a no. The price to sales ratio at 0.5, I like it. So this tells me that there's value we can in this company. So, but let's continue. They pay out a dividend of 75 cents per share. I like it because I like that dividend income. And the effective return is at 2.7%, and that is a bit low, but as long as they improve that number, I'm good with it. But 2.7%, that is a low number, so that is a no for me, but I like the dividend, so that is a good go. Now, we don't have I have to report this to our developer because normally return on equity basically tells you investors about the company's ability to create return on the capital that you invest in them. So this is a critical thing to take a look at. Now, return on assets is at 9%. I like it. So that is a good go. I like that. So they are trading currently at $27 per share. If we take a look at the 50-day moving average, we are trading below, but also trading below the 200-day moving average. This is a clear signal that we might see the price continue to fall. And if we take a glance at the chart, we can see that we used to move at higher levels, but now we have turned and now we are moving on lower levels. And we might see the price continue to fall, but we'll take a look at the technical analysis as we go on. But let's move over to the income statement, and what we can see here on the income statement is that the total revenue went from $48.2 billion in 2016 up to $56.6 billion in 2020, and has been growing steadily every year. I like this. Now, the gross profit went from $9 billion up to $10.4 billion, has been growing steadily every year. We fell off the last year, but overall trend is positive. I like it. The net income went from $2.5 billion up to $2.8 billion, and we stagnated for 2 years, then we moved up to $5.3 billion, but the last 2 years we've been moving lower levels, so this is a minus. I want to see a continuation, a growth continuation. So having a lower number for 2 years, that is a minus. Now let's move over to the balance sheet, and what we are interested here is that the current assets versus the current liabilities, and we can see that the current assets is at $20.6 billion and the current liability is at $26.2 billion. So this is a minus. We want to see the company having a higher current assets than the current liabilities, because this, if they were to convert the current assets to cash and try to pay off the current liabilities, they will be still in debt. And the total liability is at $54.6 billion. And if we take a look at 2016, we had $57 billion, and we grew that number, but for the last 3 years the numbers have been decreasing. Well, not decreasing, we increased for the last year, but we are lower than what we started 5 years ago, so that is a plus. But I would love to see the company continue to reduce their total liabilities. Now, the outstanding shares went from 1.7 billion down to 1.3 and has been falling every year, so that this is a plus. I like it, because whenever you see that the outstanding shares is decreasing, that means that the company is buying back stocks, shares. And for you as an investor, that means that your share of the company is growing. And a lot of investors miss this one, because they only take a look at, for instance, the total liabilities and see, well, this company doesn't bring in much debt. But when you take a look at the number of outstanding shares, it has been growing rapidly, because that's a way for a company to bring in more capital and not take on any debt. So whenever you see a company, it's not, the debt is not growing fast, but their outstanding share is growing fast, that is a warning signal, because that means that your share of the company is decreasing. But in this scenario, where the company is buying back shares, and I like it. So that is a major goal. Now let's move over to the cash flow, and what we are interested in here is that the operating cash flow, and we went from $3.3 billion up to $4.3 billion, and have been growing steadily every year. We fell off last year, but overall trend is positive. But what we are most interested in here is that the operating the difference between the operating cash flow and the capital expenditure, and we can see here there's a difference of $3.8 billion, and I like it. And they have had steady numbers every year. I like it, so that is a plus. Now let's move over to the key figures, and what we can tell here is that the earnings per share went from $1.4 per share up to $2.18 per share, and has been growing steadily, but for the last 2 years we have seen lower numbers, so that is a minus. Revenue per share went from $28 up to $43, and it has been growing steadily every year. I like it. Equity per share went from negative $2 down to negative $1.7 per share, and for the last 2 years we improved the numbers. But we fell off just the last year, but I like it because they are improving their number. But I would like to see a positive equity per share. Now the dividend, they have been paying out 50 dividend every year. 2016 they paid out 50 cents, and then increased to 76 cents per share, and has been growing steadily every year. I like it. I like that dividend income, the yearly income, but also that they have been increasing the payout. I like it. Now the dividend share went from 34% up to 35%, and has been, well, we paid out less in 2018, but overall we've been around 30-35%. I like it, so that is a plus. I like companies that pay out less than 60%, because I want some of that capital to remain in the business for them to reinvest in the company, become more efficient, or do some acquisition. So paying less than 60%, I like it. Now the gross margin went from 18.6% down to 18.4%, and we fell off a couple of years, then got back up. But we have been around 18%. Not a huge fluctuation, but that is a minus. I would love to see the company become more and more efficient. And if we take a look at 2020, we had a gross margin of 18.4%. That means that your total your cost of goods sold is very high. Now we need to be cautious and look how the industry looks, and not just say, okay, this is how HPQ their numbers. We need to look at the other company in the industry and compare that. But imagine selling a product for $1 and you get to keep 18.4% of that dollar, and you still got your operating costs to pay. So 18, that is way too low, and I would like to see the numbers improve. So that is a minus. The operating margin went from 7% down to 5.7%. It has been falling every year. We got back up this last year, but overall trend is negative. That is a minus. I want to see them reduce their operating cost and become more efficient. Now the profit margin went from 5.17% down to 5%, and it has been falling. We reached 9% one year, but overall numbers have been around 5%, and that is a minus. I need to see them improve the numbers, and 5%, that is just way too low. I like companies with a profit margin of 15% or higher. So having a number of 5%, that is just way too low. Now return on equity went from negative 64% and down to negative 127%. So I'm not liking this at all. This is a major minus. Return on equity tells you about the company's ability to create a return on the capital you invest in them. So you need to take a look at it before you invest your money into a company. Are they able to create a return on that equity? Now return on assets went from 8.6% down to 8.2%. We fell off. We grew one year, but overall, and then for the last two years we've been falling, having lower numbers. I don't like this at all. A bit of fluctuation. I need to see stability. That's what investors look for. Now solidity went from negative 13% and down to negative 6%, and we reduced that number a couple of years. Overall trend, I don't like this at all. We improved. I'm not liking this at all. Solidity, basically what it tells you is how much of the company's total, how much of the total assets is financed by the equity. But it also lets you know about the company's financial strength for the short term. And looking at these numbers, I don't like it at all. So that is a minus. Now balance sheet liquidity went from 0.9 up to 1.4, and we have grown every year. We fell off one year, but not by much. Yeah, for the last 2 years we fell off. But overall, what we started, 2020 is better than 2016, so that is a plus. But I also want them to improve that number. But balance sheet liquidity basically tells you about the company's financial strength for the long term. Now debt ratio went from negative 14 down to negative 24. And by looking at these numbers, basically what the debt ratio tells you is that, for instance, this one tells you about that the company has 24 times more equity than debt in the company. So that is a plus. I like it. Now we have gone through the income statement, the balance sheet, the cash flow, the key figures, and now we're going to take a look at a key feature of our software, and that is the pillars. Basically, pillars is, it gives you an easy to digest overview of the company's performance in just one picture, one slide, and it saves you time. So everything we have gone through so far, you get it in one slide. So if we summarize, we can tell that the PE ratio is below 20. That is a positive. They pay out dividends, which is positive. The dividend payout share is less than 60%, that is positive. And the dividends have increased over the past 5 years, that is positive. And the number of outstanding shares have decreased, which is positive. And revenue decreased over the past 5 years, that is negative. Profit margin below 15%, that is negative. And the profit decreased over the past 5 years, that is negative. Now, the current assets is less than the current liabilities, which is negative. Solidity increased over the past 5 years, positive. And balance sheet liquidity increased over the past 5 years, that is positive. And debt equity ratio decreased over the past 5 years, that is positive. And total liability have decreased over the past 5 years, that is positive. Guys, as you can tell, in just one picture, one slide, we get a holistic overview of the company's performance. Now, if you want to dig through the numbers, you can dig through the numbers, or you can use the pillars to save you time and still get the same value. And you can have this tool for only $25 per month, and you also get access to our analysis page where we publish more articles and videos for you to enjoy, but also access to the chat so you can chat with me alongside other members. So join today for only $25 per month. This tool is for you to have. Now let's jump over to the technical analysis of the stock. So here we have the chart, and we can see right away that we are consolidating. Let me change color to green. Let me lay down the resistance level, something like that. And let's change that color to red. As you can tell, we are consolidating. We're not moving up, we're not moving down, but we're moving sideways. If we take a look at the difference between the lowest point to the high, one of the highest point in the channel, we are looking at a price move of 300%, which is great. But currently what we are looking at right now is that we are, if we zoom in a bit, that we are in a down moving trend. If we lay down the resistance level here and then the support line over here, and you can tell that, and let's change that color to green. As you can tell, I think we are going to see, as we saw before, that the price is below the 50 and the 200-day moving average, which indicates that we will see the stock price move even lower and lower. And as we are in a negative channel here, we might see the price move like this down to the support line, down to the support line, what used to be a resistance line, and we might see price move up. And if it does break above the channel, you should wait before and see the price go back up, and then if the price go back up and breaks the previous high, then that's a buy. But I would like to see the stock, but I think the stock will instead move down to the channel. And if you buy this stock, this is not an interesting stock. If you are patient and wait for maybe a couple of years and see the stock move down to the channel, and you might reach a level of $15 or $16 per share, then that's positions to buy. But that is also a huge risk because you're trading in the middle of the channel. But what I would do, and if you're buying the stock, there is only one thing you're interested of. It's the dividend. You want that income. That's why you're buying this stock. But if you would like to do some price move, then I would suggest, or what I'm not suggesting, what I would do is I would wait for the price to move back to the channel and then buy around $15 per share, and then just earn that income and sell the stocks a couple of years down, and when it hits the resistance level again. So that's how I would trade the stock. How would you trade the stock? Please let me know in the comment box below. And guys, this is it for this episode, and please give me a thumbs up, comment, subscribe, and let me know what you think, also what stocks to take a look at. Until next time, guys, take care. Bye bye.